In the second chapter, we would be covering financial statement analysis. In this chapter, we will try and understand what a financial statement is, what is meant by financial statement analysis, and we'll also be discussing a few techniques that will be coming under financial statement analysis. When we had learned the topics earlier, we spoke about some of the financial statements that would be used by the business. We saw that trading account is a statement which is used by the business. We saw that profit and loss account is a statement which is used by the business. We saw that these two statements together, it is referred to as the income statement of the firm. We spoke about balance sheet. We saw that balance sheet is referred to as it helps us to understand the financial position of the firm. So we have been talking about some of the examples of financial statement. Now, from a accounting point of view and from a finance point of view, there are many more statements a business can be using. So, for example, fund flow statement, cash flow statement, budget, all these are statements which can be used by a business. Now, why does a business use financial statement? What is the need? What is the purpose behind a financial statement? So before that, we will try and understand what is management accounting. So financial statement analysis is a concept which falls under management accounting. So earlier when we dealt, we saw that there are three branches of accounting: financial accounting, cost accounting, management accounting. Now, what is management accounting? Management accounting is the branch of accounting that helps a business to take decision. It helps you to understand what are the consequences or what are the outcomes of the decisions that you end up taking. Okay, so management accounting is the branch of accounting which helps you to understand what are the consequences, what is the outcome of the decisions that you would be taking. Now, why do we have management accounting? The reason why we have management accounting as a branch of accounting is to help the management to take better business decisions. And in a business, especially the top level management, they have to continuously take decisions. They have to take, should we buy this company? Should we sell this company? Should we close down this division? Should we focus on a specific product line? There are so many decisions which have to be taken. So in order to take good decisions, in order to take carefully planned and meticulous decisions, there is a huge need for them to ensure that the decision-taking process is very effective and it is very smooth. So this is where management accounting comes into picture. So one of the recent developments which has happened off lately is that the wholesale brand, which is called as Metro Retail, this has now been acquired by Reliance. It has been acquired by Reliance Retail. So Reliance Retail has decided to take over Metro Retail. Now, before taking this decision, the management of Reliance needs to know, are they taking the right decision or not? What is the impact that this decision is likely to have on them? Will it help them to increase their profitability, or will it have other consequences? So these kind of evaluations, they would need some baseline, they would need some guidance, they would need some insights. So these insights are provided by management accounting. Management accounting also helps you to review the performance. So there are some techniques, there are some indicators, there are some forms of analysis that you can carry out to ensure that are you progressing in the right direction. So this is an introduction to management accounting. Now let's discuss some of the definitions of management accounting. SEMA, which is Chartered Institute of Management Accountants in UK, this is how they have defined management accounting: application of professional knowledge and skill in the presentation of accounting information such a way as to assist management in formulation of policies and in planning and control of the operations of the undertaking. Another definition, it includes the methods, concepts necessary for effective planning, for choosing among alternate business actions, and for control through evaluation and interpretation of performances. So the sum and substance of all this is that management accounting is the branch of accounting which helps the business to take better business decisions. Now, what are the objectives? So any business, the objective is to maximize profit or minimize loss. Okay. So one way that you can focus on is you can try and maximize your profit. On the other side, you can try and minimize your losses. So when you keep minimizing your losses, automatically your business will eventually turn out to be profitable. Or another way is you could think of increasing your profit. So how can you increase profit? You can increase the profit by increasing your sales. So I was just going through ID Fresh's website, and the website was talking, how they started off manufacturing idli batter. From idli batter, they scaled up, and finally they introduced ready-made chapati and parota. So from there, they scaled up. Then they started introducing other products. Eventually, it turned out to be a multi-core business. Now, when we talk about objectives of management accounting, there are four objectives which comes into picture: planning, organizing, controlling, interpreting of financial statements. So, what is it? What comes under planning? Planning here, we are trying to set organizational objectives. So just like us as individuals, we would have aspirations, we would have personal goals, we would have some certain areas that we would be liking to focus on. Probably we want a career advancement, or we want to change in our job role, or we want to carry out or fulfill some certification. There would be some IJPs that we would be planning to attend. So how do you get there? In your personal goals, let's say you want to move to a different role. Okay, maybe you are a senior technical engineer right now. You want to move to the level of an architect, a software architect, or an IT architect. So to get there, what is it that you have to do? What are the qualifications? What are the credentials that you need to pick up? So these kind of things, these kind of thought process would be applied, and then you would start preparing yourself for that. Similarly, organizations would also have organizational objectives or organizational goals. What is the end result that they are hoping to achieve? What is the end result that they're hoping to attain? So to get there, what is it that they need to do? Do they need to increase their product lines? Do they need to start manufacturing in a different location? Do they need to set up a new plant? These are the kind of thought processes that would be coming through or running through their mind. Second step is organizing. So organizing is where now you have got your objective, you have got your end result in place. To get there, what all are the action items that you have to take? Should you introduce a new product line? Should you try and scale up your sales? Should you look at expanding into a new geography? So some of these thought processes you would be applying under organizing. Then you have controlling. So you have to set some benchmarks. You have to set some benchmarks to make sure that everyone is progressing in the right direction. Everyone is moving in the right way. So for that, you would have some benchmarks, you would have some control mechanisms put in place. Okay. So for example, if you are in a sales role, your manager would call you and tell you, this month, this is the target that you have to fulfill. Or let's say if you are in a so I'm pretty sure that we all go through an appraisal process way back in our organization. Now, why do we have these appraisal mechanisms in place? We have these appraisal mechanisms in place to make sure that we are helping the organization to fulfill the overall organizational objectives, the overall organizational aspirations. Then the final objective is that we should be able to interpret financial statements. Now, financial statements are complex documents which may not, unless and until you are initiated and enlightened in that area, it may be very difficult for you to understand some of these matrices which are mentioned, or some of these values which are mentioned in the financial statement. So interpretation is very crucial. So it's like when you go for a blood checkup, or when you go for a full body checkup. As a part of your full body checkup, there would be some blood tests which would be conducted. There would be some hemoglobin test which would be done. They would look at what is the cholesterol level in your blood, what is the vitamin level in your blood, all that. Okay? So when you get your result, you would see that there is the actual value, the results they have found by examining your blood, and then on the other side they would give you a range. Okay, so if it's between this and then this, you're okay. If it's less than this, then you're not so okay. If it's higher than this, it is still not okay. So why do we have that kind of a guidance? We have that kind of a guidance to help us to interpret the values of the test that we have carried out. So it gives us a better understanding. It gives us a better insight about what is going on in our body. So similarly, we should be in a position to interpret the values which are mentioned in the financial statement. Now, moving forward from there, so here I'm explaining the objectives in detail once again. So we've already covered this. And now we will talk about the relationship between the three branches of accounting. So as soon as a transaction takes place, financial accounting kicks in. Financial accounting is responsible for carrying out the bookkeeping activities. So they would prepare journals, ledgers. Eventually, they will prepare the final accounts. From here, the financial accountant will get a input to cost accountant and management accountant. Okay. So cost accountant would evaluate the cost information. Management accountant will use the information to take business decisions. So this is how the information would flow. Now, cost accountant would evaluate cost related information, provide these insights to the management accountant. Okay. So provide these insights to the management accountant. Now, together with the inputs from financial accounting and cost accounting, what the management accountant would do is the management accountant will provide these insights to the management for them to take decisions. So what the management accountant would do is whatever information that they are able to generate or they are able to collate with the help of the cost accountant and management accounting, that information gets passed on to the top level management, and the top level management would be using this information to take certain key business decisions. Now, when decisions are taken, those decisions in turn would translate to, again, transactions. So I gave you the example of how Reliance decided to acquire Metro Retail. So that was a decision. Now the decision translates to a transaction. Transaction would be they would have to ensure that they have the sufficient funds to buy out Metro Retail. The money needs to be exchanged with the management. Once the amount has been exchanged, then the transaction, the assets have to be exchanged. Once the assets have been exchanged, then what happens is this would in turn translate into the decision. So this is how the information flows within an organization between the three branches of accounting. So I'll repeat this once again. Financial account is responsible for bookkeeping. Cost accountant picks up the cost information. Management accountant picks up the other key decisions. So these two works in tandem. The management accountant would process this information, pass on this as insights to the management to take decisions. And then again, the process kicks in. Now let's talk about some of the limitations. What are the drawbacks? What are the problems of management accounting? The first problem is that it is based on historical information. What does that mean? So whenever you have to use management accounting in picture, what really happens is that it is based on information of the past, historical information. What happened in the past? So decisions for the future are based on historical figures, historical facts, right? So there might be a good amount of chances that whatever you may be in for a surprise in for the future. So sometimes it may not be necessary that, no matter how much ever analysis that you carry out, how much ever calculation, how much ever insights that you have made, you have carried out, you may be in for a surprise. Okay, so best example is what happened on March of 2020. Okay, so the entire world was aspiring, a bright new year. Most of the corporates were gearing up for progress and advancements, etc. Okay, but in the month of March, suddenly the government decided to pull off a lockdown to contain the spread of the virus. So that was something which was not anticipated at all. No one expected that to happen. No one expected a lockdown to happen. This was something that was totally unexpected. Okay, so what happens is you are using historical information to take decisions for the future. Another example is what happened with respect to this year, in 2020, in the month of February. No one expected Russia to go on a war against Ukraine. It took the entire world by surprise. And what was a surprising fact was that everyone expected, actually, everyone expected, they would fall immediately before the might and the power of Russia. But on the other side, that was not what exactly happened. Okay, that was not what exactly happened. So sometimes what happens is historical information would be in for it would may take you in for a surprise. Okay, so maybe based on historical information, everyone was predicting that Ukraine will fall quickly before Russian military power, but the reverse happened. The opposite happened. So that is based on historical information. Okay. So sometimes when we take decisions for the future may be in for a surprise for us. Then second limitation is lack of knowledge. What does this mean? You might be needing some expertise. You might be needing some kind of a knowledge. You might be needing some kind of a know-how to apply management accounting techniques. So lack of knowledge is a serious concern. You need to be knowledgeable in this domain to ensure that you are able to effectively carry out activities. Okay. Then third thing is personal bias. Okay. Personal bias is something that we not only see in management accounting, we could see that in a lot of other areas as well. So your previous experience, your previous knowledge, your previous know-how in handling a certain situation could have a serious impact. It could have a serious consequence. So let's say person A, when he sees the figures, when he sees the values, he would be interpreting it in a certain way. Whereas the same pieces of information, when another person sees it, they would be interpreting that in a different way. So personal bias is a serious problem. It could be a serious concern. So interpretation of figures and facts is usually based on personal, or it is usually based on an individual judgment. So sometimes we would see, especially in medical field, okay, when we go to a young doctor who may not have so much of experience, they would be dealing the situation in a certain way. But the same medical condition, when you were to try and approach a senior doctor, the senior doctor has got a totally different approach. In some cases, you may not even have to take certain medicines in handling that particular situation. So personal bias is a serious concern. Fourth limitation of management accounting is that it is an evolving subject. It is a subject which is undergoing a lot of changes. There are a lot of transitioning. There are new techniques which have been added. There are new tools which have been added. It's not a perfect subject as such. Management accounting is relatively a very, very new concept. It is probably around 20 to 30 years old. So most of the concepts that you come across this domain, it is still undergoing a transition phase. Okay, so it's an evolving subject. Then next is psychological resistance. So here what happens is when you try and apply, or when you try and implement some of these techniques as a part and parcel of your management accounting, you could incur resistance or frictions within the organization. Okay, so let's say you have decided to ensure that that there is some kind of there are some kind of cost-cutting measures that you have decided to carry out. Now that may not be that may not be accepted, easily by your staff. Okay, it may not be easily. It may not be easily accepted by your human resource, or whatever manpower that you have within the organization may not be accepted by them. Okay, so that is what is meant by psychological resistance. So any change, okay, it's a universal known fact that any change that the business or the organization may have to undergo, it may not be easily, or it may not be smoothly accepted by everyone. Okay, now we will talk about the process of management accounting. Now, the process of management accounting is divided into 3 steps. There are 3 steps to management accounting: collection of information, analysis and interpretation, communication. So I'll repeat that. There are 3 steps: collection of information, analysis and interpretation, and finally communication. So under the first step, the management accountant has to collect the information that is needed. Okay, whatever information that is needed as a part and parcel of the business, this has to be carried out by this has to be collected. Now, the suitable sources of information for the management accountant would be cost accounting and financial accounting. Okay, so they would draw their inspirations, they would draw the information that is needed as a part and parcel of the analysis from either from cost accounting or from financial accounting. Okay, so they would be drawing their information from these 2 areas. Second step is you would be carrying out analysis and interpretation. So depending on what your need is, depending on what kind of data that you have got, you would be subjecting your information to some form of analysis. You will be applying a technique to it. You will be applying a process to it. Now, why are you applying this process? Why are you applying this technique? So that you can draw out meaningful information. Okay, so that is the second step, application of management accounting 2. Let's say you want to know the flow of cash, you will be applying cash flow analysis. If you want to understand what is happening to the funds, you will have to apply fund flow analysis. If you want to understand how is the performance of the firm, then you will have to carry out ratio analysis. So this is how you will be carrying out second step. Then the last step is communication. So once you have collected the information, once you have processed the information, you will have to communicate to the appropriate stakeholders. You will have to pass on the information. Now, it's just not that you have to pass on the information. You have to write it down in a layman's terms. Okay. So let's say if you carry out ratio analysis, you have calculated current ratio of the firm. What does that current ratio really imply? So that analysis, that interpretation has to be carried out, and it has to be passed on to the respective stakeholder. So that's what happens in the third step. So 3 steps to management accounting: collection of information, analysis and interpretation, and finally communication. Now, let's move forward from here. Now, let's talk about financial statement analysis. What is meant by financial statement analysis? Financial statement analysis is the process of evaluating the relationship between component parts of a financial statement. In your financial statement, there are different values which are disclosed. There are different values which are given out. So what do these values imply? What do these values interpret? What do these values give out? That is what is meant by financial statement analysis. So what is the relationship? If your assets are so much, if your liabilities are so much, what is the meaning? If you have so much of land as your fixed asset, if you have so much of cash as your current asset, what does it imply? So there is this relationship between the items, establishing the relationship between these items, that is called as financial statement analysis. Now, for you to carry out financial statement analysis, there are 3 steps that you have to follow. Okay? There are again 3 steps that you will have to carry out. First is selection, classification, interpretation. Okay? So for you to carry out financial statement analysis in your organization, there are 3 steps that you will have to carry out. Step number 1, selection. What happens over here? You have to identify what is your objective behind carrying out that financial statement analysis. I'll repeat that. In step 1, you will have to understand, you will have to figure out what is the objective behind that financial statement analysis. So once you have said, okay, are you interested in knowing profitability? Are you interested in knowing financial position? Or do you want to know what is your liquidity position? Are you planning to go in for a merger and acquisition? Are you planning to go for a joint venture? So what is your objective? What is the end result that you wish to see? So based on that, you will have to define your purpose and the need. Once the purpose and need has been defined, then you will have to go in for selecting the appropriate data for the need. Okay, so next, what you will have to do is you will have to go in for selecting the data to fulfill that need. Okay, so that is what happens in step 1. Excuse me. So once this is done, then you will go in for step two. Step two is classification. So as a part and parcel of this step, what you would be doing is you would be applying a tool. So you would be applying one of the financial statement analysis tools. So maybe trend analysis. It could be common size statement. It could be comparative statement. You would be applying one of these tools as a part of step two. So basically, with the help of step two, what you would be doing is you would be rearranging the data. So there is some information available to you in the from the state data that you have collected. Now you're rearranging the data. So through second step, depending on what your objective, depending on what your purpose is, you would be applying a tool. So once the tool gets applied, then you will go to step three. So what is step three? In step three, you would be going in for interpretation. You would be trying to draw meanings. You'll be trying to draw conclusions. You'll be trying to draw what does that imply? Okay, so that is what is meant by step three, interpretation. So in interpretation phase, what you would be doing is you would be carrying out some kind of you would be rewriting the statements in layman's terms. And once you have done that, you would try and communicate this information to the others with the help of some visual aids. So you may see when you go in for some meetings, they would be using some graphs, they would be using some visual aids, they might be using some kind of a music, they might be using some tables, they might be using some kind of animation. So why are they doing this? They are doing this because they wish to reinforce the information that is conveyed to you in that particular document or in that particular presentation. So to ensure that happens, that's the reason why they would go in for using these visual aids. So I'll repeat this once again. In step one, what you would be doing is you would be selecting the data. Step two, you would be classifying, that is, you would be applying some form of analysis. Then step three, you would be carrying out interpretation, that is, you would be writing out the meanings, you would be writing out the interpretations for the statements that you have prepared. Okay, so these are the steps to financial statement analysis. Now, moving forward from here, let's talk about the classification. What is the classification of financial statement analysis? Now, financial statement analysis can be broadly classified into four. I'll repeat that. Financial statement analysis can be broadly classified into four. The first classification is based on entity. Second classification is based on time. Third classification is based on modus operandi or mode of operation. And then finally, material use. So there are four major classifications of financial statement analysis. So I'll repeat this. Financial statement analysis can be classified into four. The four classifications are entity, time, mode of operation, material use. Now we will talk in detail about these classifications one by one. The first classification is based on entity. So based on entity, we have two classifications. One is called as cross-sectional analysis. Next is called as time series analysis. So based on entity, we have two classification, cross-sectional, time series. What is cross-sectional analysis? When you compare two or more businesses, it is called as cross-sectional analysis. I'll repeat that. When you compare two or more businesses, two or more business entities, that is called as cross-sectional analysis. I'll give you an example. HP, Hindustan Petroleum, is a petrochemical company. You're trying to compare that with Indian Oil, which is again another petrochemical company. So they both are in similar businesses. They both are companies of similar sizes. You're trying to compare their profit performance. That would be an example of a cross-sectional analysis. Trying to compare the performance of Wipro with IBM. Okay, both are IT companies. Both are in the business of providing software services and IT services. So you're trying to compare the performance of these two. Example of cross-sectional analysis. You're trying to evaluate the performance of Kia Motors with Maruti Suzuki. Both are automobile companies trying to compare their performance. That is an example of cross-sectional analysis. The next classification under entity is called as time series analysis. Time series analysis, you are evaluating the same item from different intervals. So basically, you're dealing with items, or you're dealing with values of the same company for different intervals. Maruti Suzuki, you want to see how was the profit in 2016, 17, 18, 19, 20. Okay, so Maruti Suzuki's profit, you are comparing for 4 or 5 years. That's an example of time series analysis. So let's say your marks. Okay, how much did you score in first semester? How much did you score in second semester? How much did you score in third semester? That would be an example of time series analysis. So in time series analysis, you're picking up the same value, you're comparing that for different in time intervals. That is called as time series analysis. Cross-sectional analysis, what you do is you take up the same item, you try and compare. You try and compare two different entities' values for the same time interval. That is called as cross-sectional analysis. So entity, time series. Okay. So based on entity, we have cross-sectional, we have time series. This is called as entity analysis. Okay. Now moving on. Next one. Based on time, based on the time interval that you're carrying the analysis for. So based on this, we have two subcategories: short-term analysis, long-term analysis. What is a short-term analysis? If the time duration for which you're carrying out the study is less than 5 years, it is called as short-term analysis. Okay, if the time period for which you're carrying out the analysis is less than 5 years, it is called as short-term analysis. If the time window, the time interval for which you're carrying out the evaluation, for which you're carrying out if it's beyond 5 years, it's called as long-term analysis. It's called as long-term analysis. Now, between the two, long-term analysis is advisable because you would be able to understand more information. You would be able to identify more trends. That is called as long-term analysis. Short-term analysis, short period of time, okay, it may not be completely reliable. Long-term analysis, long periods of time, and it helps you to identify long-term trends. That is called as long-term analysis. Then based on the sources of information, we have internal analysis, then we have external analysis. Based on the source that you are, or based on the sources of information, we have internal analysis, we have external analysis. So what is an internal analysis? Internal analysis is analysis which is done within the organization. Okay, so it could be an analysis which is done by the employees within the organization. So when the employees within the organization, when they are carrying out the analysis, what happens is they would have access to extensive information. They would have access to more information. Okay, so because of this, the analysis that they would be doing, it would be more insightful. It would be more. It would have greater, insights. There would be more aspects that would be considered as a part of your internal analysis. Then we have what is called as external analysis. What is external analysis? When the analysis is done by someone outside the organization. Okay, it's not an internal entity. It is done by someone outside the organization. That is called as external analysis. So what happens in external analysis is they would have access to limited information. Okay, they would have access to limited information, and because they have access to limited information, this analysis may not be complete in nature. Then, based on mode of operation, okay, based on the mode of operation, we have what is called as horizontal analysis, and then we have vertical analysis. Okay, based on the mode of operation, it's called as modus operandi. Based on that, we have horizontal analysis, and then we have vertical analysis. What is horizontal analysis? Horizontal analysis, you are picking up the same item, you're comparing it for different time intervals. You're picking up the same item, you are comparing it for different time intervals. That is called as horizontal analysis. Sales volume for 10 years. Example of a horizontal analysis. Vertical analysis, what happens is you are picking up the same time interval, but you're trying to see what is the relationship between two or three different items. Okay, you're trying to see what is the relationship that exists between two or three items. That is called as vertical analysis. Okay, that is called as vertical analysis. So horizontal analysis, same item, different time interval. Vertical analysis, same time interval, you're trying to establish the relationship between two or three items. That is called as vertical analysis. So in horizontal analysis, what happens is you're picking up the same item for different time interval. Vertical analysis, same time interval, you're focusing on different items. Okay, so we have spoken about financial statement analysis. We saw that financial statement analysis can be classified into four, where we have classification based on entity, classification based on time, classification based on source of information, classification based on mode of operation.